guys, Dr. Michael Young here. Hope everything's going great in your world. We are pushing right ahead in our next module, our next lesson. We're talking about the global capital market. This is an interesting topic. It's something that there are lots of big changes happening right now in the world of finance, and so therefore global capital markets. In this lesson, we are really taking the perspective of a particular borrower because we're interested in how businesses, what they want from international capital markets, the interaction between savers and borrowers and how that takes place and what's the reason for it and what are some of the impacts. So let's dig right into it then. All right, so the generic capital market, and by this your textbook just means the big capital market that's out there. What's the purpose of this? Well, people say, for example, myself, I'm saving. I'm an individual saver, an investor. I'm trying to save up money for the day that I'm able to retire. And so that you've got these investors and savers on the one hand, and then you've got these commercial banks and these investment banks on the other hand. And this is really the players in the global financial market. You may have heard of investment banks. Investment banks are the ones that do the IPOs. Those are the ones that will actually take a company and divide it up into bits and pieces, into shares, and then sell this to investors on global capital markets. And so they're the ones that turn private companies into public companies. Commercial banks, on the other hand, have a more indirect function, and they simply take savings or from people and they invest it or they loan it to commercial enterprises. And so you've got the commercial banks doing the more indirect function and investment banks doing a more direct function. So the main players, you've got people like myself, individuals, but you also have companies and you also have institutions. A lot of my savings or investing is done through institutions. I have some shares of stock that I own directly, but a lot of the shares of stock and equity that I own in companies is through other institutions. For example, being a teacher, I have a lot of my savings through the Teachers Insurance and Annuity Association. So then you've got the market makers, you've got the commercial bankers and the investment bankers, and then you've got the borrowers. These can be individuals, they can be companies, they can be governments, and so this is the main players in what your textbook is called the generic capital market. How do we get this excess capital in the hands of people that can use it? So, right, your textbook, this is an odd way of doing it. It's not the way that I would have done it, but we have to stick with this nomenclature. We have to stick with the terminology that your textbook's using so you won't get confused on the quizzes and exams. Capital market loans talk about two types. Equity loans, when a corporation sells stock to investors, I normally think of that as being owners, but I'm going to go with this terminology. Then you also have debt loans. This is when they borrow money from a bank, a commercial loan, and requires the corporation to repay a predetermined portion of the loan amount at regular intervals regardless of how much profit it is making. Big difference here is equity loans, as your textbook is calling, don't have to be paid back. And the people that are buying these shares, and so the equity lenders, can lose all of their investment. But the debt loans, those have to be paid back as long as the borrower is still solvent. What's the purpose of having a global capital market? Why can't we just leave all capital markets as domestic? Well, it's simply supply and demand. The bigger is your pool of capital, the bigger is the supply. This keeps down the cost of the capital. And so this means that, by going into global capital markets, the borrowers can get that money at a lower cost. Your textbook has a figure to demonstrate that. A little bit of economics and a graph here. Pull this down here so it's out of the way. On the vertical axis, we got the cost of capital. On the horizontal axis, we've got the dollars. And so your textbook's using the example, I believe it's a Deutsche Bank example. Deutsche Bank would like to borrow money, either through, they're not making the distinction here, through equity loans or debt loans, equity lending or debt lending. As you can see, law of demand tells us that as the price of anything decreases, the quantity demanded increases, right? Inverse relationship. And we have two different supply curves here. The law of supply tells us that as the price of anything increases, the quantity supplied increases. And so they're just simply showing here that the domestic, the G supply curve, is back. It's not as high as is the international supply curve, the SSI. And so by pushing onto global capital markets, a company like Deutsche Bank could be able to get a lower interest rate, and therefore would probably demand more dollars to be lended. So it's a very simple graph. So borrowers are more interested in having an international capital market because it pushes down the cost of their capital. For investors, say myself, again, if I can use myself as an example, well, if you've taken finance courses, any type of investing courses, you have learned from your finance professors and from your studies that you're better off to diversify. And they can show you this mathematically. If you diversify your portfolio, then you mathematically, unless you have some special information, which most people don't, and unless you're able to beat the markets, which is really, really difficult, and most people cannot, including myself. So we are better off diversifying. By diversifying, we have more opportunities, and the more we diversify, the less likely we are to lose everything. It's not putting your eggs all in one basket. So investors can diversify their portfolios internationally, reducing risk. And international, I happen to have some money invested, as you might have guessed, in Hong Kong, just because of my long experience there. And that's a benefit to me, because right now, with the U.S. market, period of turmoil, lots of things happening. There's always the chance that the U.S. market could go down. And there's not necessarily, usually they're somewhat correlated, but not perfectly correlated, correlation between different markets in different countries. So by investing in internationally, you can help to diversify your risk. Global technology, one thing that's happening is information technology continues to advance. This has made international investing easier, instantaneous communication, 24-hour trading. However, the downside to that is that these shocks spread quickly. So, global capital market, we're still talking about the benefits. It's grown very, very rapidly. If you look at global capital markets, it's mind-boggling how much money is actually traded. The amount of money traded on global capital markets is much, much greater than all of the world GDP. There are trillions of dollars that are traded, trillions of dollars worth of currency traded every day, and it just boggles the mind how much is actually happening. And this has grown quite rapidly, and it's caused some concern among some people. A lot of that has to do with countries changing their regulatory tone, and also the capital controls that many countries had in the 1970s. And as might be guessed, not all economists are really so gung-ho on global capital markets. For example, investing, putting money into companies is supposed to be different from gambling. It's not supposed to be entirely speculative. Yes, there is a speculative element, but it's supposed to be based on information about companies. It's supposed to be based on and help to cause capital to flow to places that it's more needed. And there are some people, including Martin Feldstein, a famous economist, who believes that the costs of global capital markets outweigh the benefits at times. It causes people to be more speculative in their so-called investing strategies. And hot money, you might have heard about hot money. This is short-term capital that kind of sloshes around and it flows out of countries where there might be perceived to be a risk, and it flows into companies that are, or countries that are thought to be at less risk in any particular time. For example, whenever the war in Ukraine started, money began to flow into the United States because that's supposed to be a safe haven. This was hot money, and a lot of it was flowing out of Eastern Europe, and particularly Ukraine and Russia. Patient money, on the other hand, supports long-term cross-border capital flows. And people don't necessarily have as much information about foreign companies. And one thing that I'm following right now, you might have seen it too, is the Chinese companies that are listed on the New York Stock Exchange have not been allowing audits of their companies' books, which goes against the rules of the Securities and Exchange Commission, the SEC. So, yeah, if people don't know what's happening to companies and they're just simply gambling, right? If they don't really have information and they don't really have audit, they really don't have books. So this can cause investors to react to dramatic events in foreign nations and move their money too quickly. The one that I'm most interested in, of course, is what's happening with the Chinese companies that are listed in the United States. And it's something that, honestly, I would never knowingly invest in a Chinese company because I don't believe that they're fully transparent. And so I don't believe that, it's not what we normally think of as investing in, say, the United States. Next thing we're going to talk about is the euro currency market. As this definition tells you right here, euro currency is any currency that's banked outside of the country of origin. These euro dollars account for 2/3 of all euro currencies. They can be created anywhere in the world. They're an important and relatively low source of funds for international businesses. As globalization has taken place, we've had a globalization of markets. We've had a globalization of capital markets. And so, as you might guess, this has caused an internationalization of corporate ownership. Companies historically rooted in one nation are listing stock in equity markets of other countries and other nations. Most importantly, again, has been the phenomenon of emerging economies trying to invest their markets on their companies and shares on the New York Stock Exchange. New York Stock Exchange is the biggest, deepest pool of capital in the entire world, so lots of companies would like to invest there. But it's caused a lot of problems as well as benefits. Same thing with bond markets. Many companies issue bonds, and a bond is a promise to pay a certain amount of money back at a particular point in time. It's kind of like borrowing from a bank, but you do it through another investment or another type of vehicle, or it could even be issued by an individual in extreme cases, but not very often. And those bonds can be sold outside the borrower's country, and are used and are dominated in the currency of the country in which they are issued. There's something happening right now you might have seen. Again, a lot of what's happening in global markets right now is because of the war in Ukraine. And Russia had borrowed money in U.S. dollars. They borrowed dollars. They spent the dollars, and they're supposed to pay back the money in dollars. But because they're having a shortage of dollars flowing into the country because of sanctions now, they're threatening, and it's really kind of a threat, to pay back the money in terms of rubles. So that's something that's happening on international markets right now. So in summary, growth of the global capital market. It's created opportunities for international businesses who want to borrow and invest money. It's a bigger pie for everyone. pushes down the cost of capital, creates better deals on both sides. It's a win-win solution. But at the same time, global market lacks government regulation. Foreign exchange risk is greater. Firms, institutions, and individuals can diversify their investments to limit risks. Hope that was useful. This is Michael saying we'll see you next time.